The latest data just came out and interest rates aren't going to be coming down like they expected, but house prices might surprise you. Let's start off with where we're at today. This was the updated market expectations for the Bank of Canada overnight rate in 2024 just 2 weeks ago. The latest projections had the first rate cut most likely in the March meeting. Markets were expecting the overnight rate to be at 3.5 versus the 3.75 last month and 4.25 only in November. As of today, we're down to just 1% projection due to stronger than expected inflation. Rate cut projections have been absolutely crazy over the past few months, with economists and traders trying to wrestle with some extremely volatile macro data. The key takeaway is that markets have cut the rate expectations slightly, with the first cut now expected in April. Previously, it was in March. And with only a 1% cut expected through 2024 instead of the 1.25 that we thought. We need to zoom out and take a look at the big picture. Rate cuts are coming and real estate prices and consumer confidence are trending upwards after we saw the bottom in November. So we can see a positive future, but how did we get here and what causes rates to go up and down? Number one, supply and demand. There are a few factors, and interest rate levels are a factor in supply and demand of credit. An increase in the demand for money or credit will raise the interest rates, while the decrease in demand for credit will decrease them. If you remember back in 2020 after COVID hit, people weren't buying homes, cars, or much of anything. There was so little demand that rates tumbled over 50% in less than a year to try and push demand back up into the market. Number two is inflation. Inflation will also affect interest rate levels. The higher the inflation rate, the more interest rates are likely to rise. And this happens because lenders will demand higher interest rates as compensation for the decrease in purchasing power of the money that they're paid in the future. Remember, when people and businesses think that inflation is going to be higher, they're going to spend more money today, which runs the risk of causing higher inflation in the future. It's difficult for the Bank of Canada to cut aggressively when inflation expectations are higher. The Bank of Canada survey data last week showed that consumer and business inflation expectations are still way above normal levels and are staying higher than anyone expected. Number three, bond yields. Government bond yields are risk-free investment, while mortgages are risky investments. To make up for the risk, there is a risk premium added onto a mortgage rate above the bond yields. This compensates investors for the additional risk that they're taking on. The 5-year bond yield is the basis for most fixed mortgage rates. So if the 5-year bond yields go up, you can expect fixed term mortgages to rise as well. Since bond yields are a main determinant of fixed mortgage rate pricing, this will put a floor under fixed mortgage rates for now. It's still possible to find some 5-year fixed rates under 5%, but they're not going to be going a lot lower until we see 5-year bond yields back closer to 3% again, which may not be happening until spring. As to what's driving the change in rate projections, there were two main things that happened the past couple weeks that point to stickier inflation than expected. The first is the inflation reading itself. Last month, we expected that we would see an uptick in headline CPI, so the fact that CPI rose is not overly concerning, but what was a tad unexpected was the uptick in core inflation measures. These are metrics that the Bank of Canada pays the most attention to. This is why we are rethinking a March cut and repricing the total rate cuts in 2024. It also forced bond yields higher, with a 5-year bond yield up now almost 0.5% in a straight line to start the year. I'm going to be updating you on a bi-weekly basis on how these rate cut expectations are going to change and how we're hoping to see more than 1% drop by the end of the year. All right, quick pause on this video. Listen, before I say anything, this isn't coming from me, this is coming from the entire team. We need more subs. A lot of our viewers are still not subscribed, so please like, share, and comment below on the type of content that you'd like to see next. Now onto the scary part of the video, the housing inventory. When I say things are looking scary out there for buyers because of the lack of inventory across Canada, I say that because of the data that we have in front of us and no motivation for you to buy or sell. Yes, you are reading that correctly. Single-family building permits across Canada have fallen to levels last seen in the early 1980s. It's true in Ontario, but the chart is especially scary in BC, where we have to go back 45 years for single-family starts to be this low. Since permits always lead housing starts, you can expect construction activity to slow sharply in the coming months. That's a scary thought when you consider that in Q4, we started building only one new single-family home for every 25 people added to the population. This data is showing us something very apparent. New supply will be very low over the next couple of years, and resale inventory is not high by any means. Higher than last year, sure, but not high. Consider Calgary real estate inventory and sales. Calgary real estate inventory is some of the lowest that we've seen in decades, and we're still seeing a large amount of migration to Alberta, and we're still one of the most affordable provinces with one of the strongest economies. We're expecting Calgary home prices to rise by 6 to 8%, but we should temper expectations across Canada. The reality is, even when we see models with a 4% interest rate, the monthly mortgage payment needed to buy into a market is still 70% higher than it was in 2021. This means that while sales still have some room to rise, we'll probably be a long time returning to those crazy boom times of 2021 and early 2022.